Welcome to the deep dive. You know that feeling when you step outside and the air just feels, well, charged?
Uh-huh.
That's kind of what the economic climate feels like right now, doesn't it? A
Yeah.
real sense of uncertainty hanging around.
Absolutely. Yeah, it's like we're all trying to make sense of a financial landscape that seems to be, I don't know, shifting under our feet almost constantly.
Exactly. And that's precisely why you've brought this incredible collection of recent financial news to the table today.
Yeah.
We're going to plunge into what's happening with gold's record-breaking climb, the dollar's unexpected dip, Argentina's ambitious economic shakeup, and maybe surprisingly, Bitcoin's pretty steady performance lately.
Right. We've got a really rich set of information this time. Think of it as a puzzle, maybe, with pieces ranging from a detailed JP Morgan research report really digging into gold
Okay.
to firsthand accounts from like the Buenos Aires Times and Al Jazeera on the ground in Argentina. That's a close-up look at Bitcoin from Trader Factor and then broader analyses of the dollar and, recession worries from the Independent and Morningstar.
Mm.
We even have an academic study from PubMed Central looking at how Bitcoin moves relative to other assets, recession forecasts from Forbes, articles buzzing about coffee price speculation.
Coffee.
Yeah. And a Zaya analysis of the dollar's value, some, well, let's just say spirited debate from Reddit's Arbuckle.
Yes.
And finally, insights from finance magnates, Investopedia, and Did Food on Gold, and yes, coffee again.
What a mix. So our mission then is to sift through all of this and really pinpoint the crucial connections, right?
Exactly.
To understand how these seemingly separate financial stories are actually, well, intertwined and what the key takeaways are for you listening as you navigate all of this.
Let's do it.
Okay, let's kick things off with something that's been catching everyone's eye. Gold. I mean, it's not just going up, it's really, really taking off.
It certainly is. Yeah, the JP Morgan research report highlights that gold prices haven't just nudged upwards, they've made a significant leap. New record highs in early 2025.
And is there a specific trigger they point to?
Well, this surge, interestingly, coincided with President Trump's return and his renewed emphasis on tariffs.
Tariffs.
Yeah.
Right. Feels like we can't have a financial discussion these days without that word popping up. So with this renewed focus, what are the experts, what are JP Morgan predicting for gold's trajectory?
Well, JP Morgan is actually quite optimistic, bullish even. Their analysis suggests that gold prices have further room to run. They're potentially looking at hitting $3,000 per ounce.
Wow.
Yeah, by the final quarter of 2025.
$3,000. That would be a massive jump from where we are now. What's fueling this? What are they seeing?
Well, several sort of well-established factors are in play. Typically, when the U.S. dollar weakens, right, gold becomes more
To
attractive.
buyers holding other currencies, yeah.
Exactly. And similarly, the expectation of lower U.S. interest rates, that reduces the opportunity cost of holding non-yielding assets like gold.
So
But beyond these basics, the report really emphasizes the ongoing economic and, geopolitical uncertainties as significant tailwinds for gold. It strengthens its role as a safe haven,
right.
a place investors turn to when things feel unstable, and as a reliable store of value that doesn't always move, in tandem with traditional assets like stocks.
So the classic idea of a flight to safety is really taking hold here.
Precisely. And it's not just individual investors seeking shelter. Central banks are also playing a crucial role.
Okay.
The JP Morgan report points to consistent and, strong buying of gold by central banks globally. The U.S., for instance, holds a substantial 74% of its total reserves in gold.
74%. That's a significant amount.
It really is.
Are we seeing other major central banks increasing their gold reserves as well?
Yes, definitely. The JP Morgan analysis specifically notes that the People's Bank of China, the PBOC, has resumed its gold purchasing. Oh, okay.
And they also make an interesting point about Chinese consumers, with the potential for the Chinese yuan to maybe lose value because of these tariff risks.
Right, the trade tensions.
Yeah, there might be a growing appetite among Chinese individuals to hold gold as a, more stable form of wealth.
That makes perfect sense. If the value of your local currency feels uncertain, something tangible like gold can be, pretty reassuring. Now, zooming out a bit, how does gold currently fit into the broader investment portfolios we see? Is it a big part?
Interestingly, no.
Yeah.
The report indicates that gold still only makes up about 2% of the total financial assets held by investors.
Only 2%. Huh.
Yeah. And furthermore, the amount of gold held in exchange-traded funds, ETFs, those baskets of gold you can easily buy and sell.
Like stocks.
Right. That hasn't reached the levels we saw back in, say, 2020. So this suggests there's still potential for more investment to flow into gold ETFs.
Okay.
KP Morgan's view is that if the overall economic picture stabilizes somewhat, and maybe the Federal Reserve starts to consider cutting interest rates, right, if rates come down.
Then the appeal of money market funds, where there's a massive $6 trillion currently parked.
$6 trillion.
Yeah, that appeal could diminish, potentially leading to a shift of those funds into gold.
Okay, so we're looking at a combination of factors. Tariffs stirring up uncertainty, a potentially weaker dollar, the prospect of lower interest rates, strong buying by central banks.
Right.
And maybe investors moving out of cash and into gold. It definitely paints a compelling picture for that $3,000 target.
Well,
It does.
now let's switch gears completely. Let's talk about a country that has certainly navigated its fair share of economic twists and turns. Argentina. Sounds like they've initiated some pretty significant changes lately.
They absolutely have. Yeah, as reported by both the Buenos Aires Times and Al Jazeera, Argentina has managed to secure a substantial U.S. $20 billion agreement with the IMF,
Okay, 20 billion.
with an initial disbursement of U.S. $12 billion up front. But maybe even more significant for their economy are the steps they're taking to ease their long-standing currency controls.
Ah, it's cepo. Exactly, el cepo, those really tight handcuffs on buying and selling U.S. dollars that have, well, plagued their economy for years.
Yeah, those strict limitations. It's been a major hurdle for Argentinians and, frankly, a source of frustration for international investors for a long, long time.
Exactly. So the Central Bank of Argentina is now allowing the peso to trade more freely, but within a defined range initially set between 1,000 and 1,400 pesos per U.S. dollar.
Okay.
And that range will gradually widen by 1% each month. So it's a notable shift away from the very rigid controls that President Milei inherited and actually initially tightened even further.
That sounds like a really fundamental change in their approach. What other specific policy adjustments are they putting in place alongside this?
Well, they're eliminating the previous U.S. $200 monthly limit for individuals wanting to exchange pesos for dollars.
Okay, that's gone.
Yeah, and getting rid of the fees associated with those transactions. Furthermore, companies will now have the ability to send newly generated dividends abroad.
Ah, important for foreign companies.
Very. Though repatriating older dividends will take more time. And crucially, businesses can now make immediate payments for imports, which was another significant restriction in the past.
So a pretty comprehensive dismantling of these capital controls then. What's been the reaction from investors in the markets to these, well, pretty bold moves?
The initial market response appears to be positive. The Global X MSCI Argentina ETF, which tracks Argentine stocks, actually saw an increase after the market closed following this news.
Okay, that's a good sign.
Yeah, and analysts quoted in the Buenos Aires Times view this as a critical step for Argentina towards eventually regaining access to international debt markets, especially after their debt restructuring back in 2020.
That's a significant indicator of confidence, or at least hope. What's the IMF's perspective on these developments? They just gave them $20 billion.
Right. The IMF managing director, Kristalina Georgieva, publicly commended President Milei's administration for their success in eliminating the fiscal deficit. She also noted that the agreed program includes contingency plans designed to address the kind of volatility we're seeing in global markets right now. Although she didn't specifically mention the U.S.-China trade tensions, her statement on social media described it as a vote of confidence in Argentina's commitment to reform and, fostering economic growth.
And what's the broader economic outlook for Argentina itself? They've certainly faced some significant challenges, particularly with inflation.
Oh, absolutely. The central bank is projecting economic growth of 5% for 2025.
5% growth, okay.
However, it's important to keep in mind that they also anticipate inflation to be around 27.5% by December of this year.
Still high, but...
Right. While this would be a substantial improvement, it comes after an inflation rate that approached nearly 300% during President Milei's first year. And this move to relax currency controls also comes, right after growing concerns among investors about a potential sharp devaluation of the peso if an agreement with the IMF wasn't reached. So it addressed that fear, too.
So Argentina's taking a big step here, trying to stabilize things and reintegrate into the global financial system, all while this international uncertainty swirls around. Okay, let's shift focus again and look at the U.S. dollar. It seems like the greenback hasn't been performing with its usual strength lately.
That's putting it mildly, yeah. According to reports from Morningstar and other financial news outlets, the US dollar has been on a definite downward trend against a number of major currencies.
Like which ones?
Well, it even reached a 10-year low against the Swiss franc
10 year.
and a 3-year low against the euro. The USD exchange rate climbed to around $1.14. That's quite a move.
Well, yeah, a 3-year low against the euro is definitely noteworthy. What are the primary factors driving this? Why is the dollar weakening so much?
The main drivers seem to be the growing uncertainty surrounding the outlook for the U.S. economy. And a significant contributor to that uncertainty is, again, the ongoing trade war and President Trump's tariff policies.
Tariffs again?
Yep. And China's recent response, imposing that substantial 125% tariff on U.S. goods, is certainly not helping to ease those concerns.
So these tariffs are having a direct, measurable impact on the dollar's strength. It's not just stock market jitters.
That's the indication. Yeah, Peter Kinsella at Union Bancaire Privée suggests that part of what we're seeing is a repatriation trade.
Repatriation.
Yeah, where European investors are selling off their dollar assets and bringing their capital back home, back to the Eurozone, maybe seeking perceived safety or just better opportunities closer to home. But on a broader level, the dollar seems to be reflecting increasing investor anxieties about a potential recession in the U.S. Interestingly, both the dollar and U.S. Treasury bonds are now behaving more like risk-sensitive assets.
Really? Not safe havens.
Less so, it seems, which makes them more susceptible to further sell-offs if these economic concerns intensify.
Morningstar called it a sell America sentiment. That sounds like a pretty significant shift in investor psychology, doesn't it?
It really is. And some analysts are even suggesting we might be witnessing the early stages of a dollar confidence crisis.
A confidence crisis. Strong words.
They are. They point to the unusual phenomenon of both stock prices and treasury bond yields declining simultaneously, which historically hasn't been the typical pattern.
Right. Usually they move inversely.
Exactly. And there are even increasing discussions and concerns about de-dollarization.
Ah, that idea again.
Yeah, the idea that if global institutions and investors start to perceive U.S. institutions or the U.S. economy as less reliable, they might start shifting capital elsewhere, potentially weakening the dollar's long-held status as the world's primary reserve currency.
That's a long-term concern that's been sort of simmering in the background for a while.
Yeah.
Are these current events, the tariffs and all, giving it more weight now?
Yeah. Well, the current situation, with rising tariffs posing a definite threat to U.S. economic growth, certainly isn't doing anything to quell those fears. Stephen Jen at Eurizon SLJ Asset Management, in his analysis on Zaya,
Okay.
he argues that the dollar has been significantly overvalued for quite some time anyway. He estimates around 19% overvalued at the end of 2024 based on his firm's valuation framework.
19% overvalued.
Yeah, looking at a wide range of currencies. He believes that a multi-year correction of the dollar's value is now underway, and this would likely happen even without the added pressure of the trade war. It's like the dollar's lofty Wall Street valuation, as he puts it, is running up against Main Street reality.
So even if the tariff situation were to somehow magically resolve itself tomorrow, this underlying weakness, or maybe overvaluation in the dollar, might persist.
That's the implication, yes. Jen highlights the U.S.'s substantial net foreign liability position.
Meaning we owe more abroad.
Right, which makes the dollar more vulnerable to sudden withdrawals of foreign investment. And he also suggests that a prolonged trade war could force the Federal Reserve to implement looser monetary policy.
Yeah, support the economy, right?
Exactly. While other regions might respond with fiscal stimulus, this divergence could further contribute to the dollar's depreciation. Even Forex strategists at ING, while they acknowledge the USD pair might be a bit overbought short-term, they still see a near-term target of 1.15. And interestingly, Lorenzo Ippoliti at Cube Investment Research even posits that President Trump's stated goal of weakening the dollar might actually be, well, gradually coming to fruition because of these policies.
Fascinating. Sort of an unintended consequence, or maybe intended. Okay, so while gold is gaining shine and the dollar is losing some of its luster, where does that leave Bitcoin? It's been known for its, well, extreme volatility in the past, but recently it sounds like it's been showing a surprising degree of stability.
That's absolutely right. Yeah, despite all the turbulence in the broader markets, driven by Trump's tariffs, Fed Chair Powell's comments on inflation, various economic data releases, Bitcoin has demonstrated remarkable resilience.
How resilient?
Trader Factor reports that it has been consistently trading above the $84,000 mark.
84,000. Okay.
Yeah.
That's quite a contrast to the dramatic price swings we've seen in Bitcoin during previous periods of market stress, isn't it?
It is.
Is this a sign that Bitcoin is starting to be viewed differently? maybe as a safe haven asset, a kind of, digital gold?
That's the million-dollar question, or maybe the $84,000 question right now. And the sources we have offer some intriguing, though not entirely consistent perspectives on this.
Okay, lay them out.
Well, the Trader Factor article raises this very debate about Bitcoin's potential role as a hedge during times of volatility. But then a more academic lens comes from this study published in PubMed Central.
PubMed, like medical journals.
Yeah, it's a broad archive. Their research, looking at data from 2013 to 2021, found that Bitcoin actually has a positive correlation with risk assets like stocks, bonds, and commodities.
Positive. So it moves with risky stuff.
Generally, yes. And a negative correlation with the US dollar, which is traditionally seen as a safe haven. So this suggests that, at least historically, Bitcoin itself behaves more like a risk-on asset.
So perhaps not quite the digital gold that some of its, strongest proponents often claim.
The findings of that particular study certainly point in that direction. They also observed that the long-term correlation between Bitcoin and other asset classes is stronger than the short-term correlation,
Meaning?
likely reflecting the short-term volatility and the speculative nature that has often characterized the Bitcoin market. Lots of noise day to day.
Got it.
Interestingly, the study found that this positive relationship between Bitcoin and risk assets tends to become even stronger during periods of extreme market shocks, like the COVID-19 pandemic.
So when things get really bad, it acts more like a risk asset.
According to this study, yes. Their overall conclusion is kind of nuanced. They say while Bitcoin can offer some hedging benefits against the US dollar, and maybe long-term against Chinese stocks, and might act as a safe haven specifically for US stocks and crude oil.
Okay.
For most other traditional assets, its primary role appears to be more as a diversifier rather than a pure, reliable safe haven.
That's a really insightful, nuanced picture. So maybe some specific hedging uses, but not a universal safety net like gold is often seen as.
Yeah.
What other factors might be influencing Bitcoin's relatively stable price action recently then, if not just safe haven demand?
Right. Well, Finance Magnets highlights a few potential factors. One is President Trump's recent, somewhat surprising endorsement of a U.S. crypto reserve that would include Bitcoin.
Yeah, that raises some eyebrows.
Definitely boosted confidence among some crypto investors. Then there's the anticipation of potential future interest rate cuts by the Fed. Lower rates can sometimes make alternative assets like Bitcoin look more attractive.
Sure, the opportunity cost again.
Exactly. And additionally, just persistent recession fears could be contributing to Bitcoin's appeal as a form of digital gold in the eyes of some investors, even if that academic research paints a slightly different picture.
So perception matters.
Absolutely. And Finance Magnates even cites some very optimistic, though, highly speculative, price predictions for Bitcoin, suggesting it could reach anywhere from $125,000 to as high as $250,000 by the end of 2025.
Whoa. Those are some truly staggering price targets.
Uh-huh.
But, okay, we also have the perspective from the Bitcoin community in our sources. What's their take on all this Bitcoin stability and these lofty predictions?
Well, the Bitcoin community, as you might guess, remains extremely skeptical. That's putting it mildly.
Shocking.
Right. They raise ongoing concerns about the potential role of Tether, the stablecoin, in allegedly, printing money to artificially inflate Bitcoin's price through what they call wash trading.
Okay, the manipulation argument.
Yep. They continue to question Bitcoin's actual real-world utility beyond speculative trading, and they express significant worries about the potential for a major price crash, particularly if a broader economic recession materializes.
So they see it collapsing in a downturn.
Many do. Some members of the community view President Trump's newfound support for crypto as potentially just another tactic to pump the price for his own benefit. However, it's interesting to note that even within this skeptical community, some do acknowledge the impact of the recent Bitcoin halving event.
Right, the supply reduction.
Exactly, which reduces the rate at which new Bitcoin is created, potentially putting some upward pressure on prices just due to reduced supply. So even the skeptics see some market mechanics at play.
It certainly sounds like a community with strongly held and often conflicting views. Now, you mentioned an intriguing link to coffee market volatility earlier. Can you elaborate on that? Seems like an odd pairing.
Yeah, it's a fascinating observation, right? The recent price swings and general volatility we're seeing in the coffee market are starting to exhibit some of the characteristics that we've kind of become accustomed to seeing in the crypto markets.
Like big, fast moves.
Yeah, big moves, maybe driven by factors beyond simple supply and demand. It might suggest that similar underlying forces, maybe significant speculative trading, disruptions to supply chains, in coffee's case due to climate,
Right.
and perhaps even a degree of herd behavior among investors could be at play in both of these seemingly unrelated markets. It's just a reminder that volatility isn't unique to just one type of asset.
Interesting parallel. Speaking of broader economic worries, the specter of a recession seems to be increasingly on people's minds. What insights do our sources offer on that front? Are the worries justified?
Unfortunately, the overall outlook seems to be leaning towards increasing pessimism. Yeah, Forbes reports that a growing number of economists now believe that a recession in the U.S. is likely to begin before the end of 2025.
How likely?
The median probability estimate now stands at a significant 65%.
65%.
Yeah.
Wow. That's a noticeably higher level of concern compared to the predictions made before previous economic downturns, isn't it?
It is. It's getting harder to ignore.
Who are some of the prominent voices raising these recessionary alarms?
Yeah.
Anyone we should pay particular attention to?
Well, Nouriel Roubini, who, famously and accurately predicted the 2008 financial crisis.
Dr. Dim, yeah.
Right. He has an even more pessimistic view. He's placing the probability of recession by the fourth quarter of 2025 at a striking 80%.
80%.
Yeah. He's expressed concerns about a confluence of negative factors, persistent high inflation, the Fed's restrictive monetary policy, significant levels of debt, particularly corporate debt,
Okay.
and escalating geopolitical tensions. He sees corporate debt as a key vulnerability.
And others.
Former Treasury Secretary Larry Summers has also increased his estimated probability of a recession. He points to the prolonged inversion of the yield curve.
Where short-term rates are higher than long-term, yeah. Often a bad sign.
Exactly. And also concerning trends in consumer credit metrics, he's drawing parallels to the economic conditions that preceded past recessions.
Okay.
And even Larry Fink, the CEO of BlackRock, as reported in The Independent, he believes the U.S. might already be in a mild recession.
Already in one. Why?
Primarily due to the uncertainty created by President Trump's tariff policies and the resulting market volatility. He specifically highlighted the prolonged periods of uncertainty around tariff pauses and renewals as a significant factor, just causing businesses to pull back, potentially leading to an economic slowdown.
So it seems there's a pretty broad consensus among some key economics thinkers, or at least growing concern, that we need to be prepared for a potential economic downturn in the near future.
It certainly seems that way, yeah.
Now, let's circle back to that coffee market speculation we touched on. What's really behind the potential for a surge in coffee prices? I mean, it's something that would directly impact a lot of us in our daily lives.
Yeah, absolutely. The primary driver appears to be the increasing impact of climate change on coffee-growing regions.
Climate change, okay, yeah.
How? As detailed in reports from VidFood and other sources, extreme weather events, think prolonged droughts, severe floods, rising average temperatures, they're significantly reducing the projected yields for coffee harvests in 2025 and beyond.
Especially for certain types of beans.
Yeah, particularly affecting the highly prized Arabica beans. This is creating genuine fears of a global shortage in supply.
So it's fundamentally a supply issue driven by these environmental factors, less coffee being grown.
Yes, but that's being amplified by significant speculation in the coffee futures market.
The traders jump in.
Exactly. Traders, including hedge funds and other institutional investors, are placing bets on rising coffee prices. They're increasing their holdings in coffee futures contracts.
Then that pushes prices up even further.
Potentially, yes. This speculative activity can inflate prices, maybe pushing them beyond what would be justified by the underlying supply and demand dynamics alone. Plus, you've got rising costs associated with agricultural production, like increased fertilizer prices and higher transportation costs, also contributing to this upward pressure.
So a perfect storm, almost.
Kinda. And BidFood also points out that the long-term outlook for coffee price stability is pretty uncertain. You've got rising global consumption.
More people drinking coffee.
Right.
Yeah.
Coupled with these falling yields, they emphasize the need for significant investment in developing new coffee-growing regions. They actually highlight the potential of Africa
Interesting.
and ensuring better returns for coffee farmers. Because the current aging farmer population in many traditional regions is also a growing concern for future supply.
It sounds like that morning cup of coffee might be getting a little more expensive soon, and it's about a lot more than just, inflation at your local cafe.
It really is. There are complex global factors at play.
Okay, finally, let's just quickly revisit the valuation of the U.S. dollar. You mentioned earlier that analysis from Zaya suggested it appeared to be overvalued. What was the reasoning behind that assessment again?
Right. According to that analysis, their valuation framework, which looks at the dollar index relative to a basket of 34 different currencies, indicated that the dollar was approximately 19% overvalued at the end of 2024.
19%.
Yeah. And what's interesting is that this period of significant overvaluation has been quite extended, almost twice as long as previous periods with the dollar was considered similarly overvalued.
What were the factors that initially drove this period of American exceptionalism, as some called it, that seemed to support such a high dollar valuation for so long?
Well, part of it was indeed based on some real economic strengths, a higher rate of productivity growth in the U.S. compared to other major developed economies,
Driven by tech.
largely driven by the dynamism and innovation within the tech sector, yes.
Huh.
However, Stephen Jen, the analyst from Urias and SLJ,
Right.
he argues that a significant portion of this American exceptionalism narrative was, in his words, a mirage, fueled by unsustainable levels of fiscal stimulus that have been pumped into the U.S. economy in recent years.
So maybe not entirely fundamentally justified, in his view.
That's his argument.
And this period of overvaluation, combined with things like the large foreign liability position you mentioned, makes the dollar particularly vulnerable now.
Precisely. That high net foreign liability position, currently around 85% of U.S. GDP, makes the dollar more susceptible to sudden shifts in foreign capital flows. If foreigners get nervous, they can pull money out quickly.
And the trade war adds to that risk.
It could exacerbate this vulnerability, yes, by putting pressure on the Fed to adopt a more accommodative or looser monetary policy to counter the economic drag. Meanwhile, other regions might be implementing fiscal stimulus. This divergence in policy responses could further contribute to the weakening of the U.S. dollar as global capital seeks potentially more attractive or stable returns elsewhere.
Okay, wow. We have covered a tremendous amount of ground today. From surging gold prices, Argentina's massive economic reforms, the weakening dollar, surprisingly stable Bitcoin, those growing recession worries, coffee market speculation, and now this dollar overvaluation correction idea. It really feels like the impact of tariffs is a common thread running through so much of this, doesn't it?
Absolutely. It really does. What becomes really clear when you look at all these different pieces of the financial puzzle is just how deeply interconnected the global economy truly is.
Yeah.
President Trump's renewed focus on tariffs is acting as a major catalyst, sending ripples across, well, pretty much all these asset classes we discussed. It's a key factor bolstering gold's safe haven appeal, a significant contributor to the dollar's current weakness, and even something being factored into Bitcoin's price movements and certainly into those growing anxieties about a potential recession.
Right.
And then you see Argentina's bold attempt at economic restructuring unfolding against this exact backdrop of global uncertainty. They're trying to navigate their own massive challenges while the major global players are grappling with these big shifts.
And even the coffee market.
Yeah. Even the volatility we're seeing in the seemingly unrelated coffee market driven by climate change and speculation offers a kind of parallel to the cryptocurrency space. It highlights just how dramatically external factors and investor sentiment can impact prices anywhere.
So the real aha moment for you, putting all this together, is recognizing that these aren't isolated financial events happening in separate bubbles. They're all interconnected parts of a larger global financial picture.
Exactly.
Constantly being influenced by geopolitics, by economic policy decisions in different countries, and just the ever-shifting sands of investor confidence and sentiment.
Yeah. Couldn't have said it better myself. Exactly. And when you consider the potential for a significant correction in the dollar's valuation, which we just discussed, and the ongoing debate about the true role and nature of Bitcoin in investment portfolios, it really raises some important questions for everyone listening as you think about your own financial future. How might traditional investment strategies need to adapt in the coming years to effectively navigate this evolving and, frankly, very interconnected landscape?
Good question.
And maybe what new factors do you anticipate will emerge as the biggest drivers of financial markets for the remainder of 2025 and beyond? It's definitely a time that calls for a careful consideration and, well, staying very well informed.